Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 13th of July. I'm Daniel Lam, your host for the podcast. The US CPI data was below expectations. Notably, core CPI growth eased from 5.3% year-on-year to 4.8%, a sharper slowdown than the 5% anticipated. Most notably, monthly core CPI inflation actually fell to a 28-month low. Importantly, the June release showed a broad-based deceleration, with most CPI items rising below 2% on a 3-month annualized basis. This disinflation process may continue over the remainder of the year, with core PCE inflation potentially undershooting the Fed's 3.9% median projection. Wholesale used vehicle auction data foreshadow further downward pressure on goods prices. Similarly, easing apartment market conditions will weigh down on the rent and owner's equivalent rent components. And lastly, the downtrend in non-housing core services inflation is likely to continue. But despite the soft inflation print, the Fed is likely to deliver a 25 bips rate hike later this month, following last week's strong labor market releases. But this may very well mark the last rate increase of the cycle, as soft inflation prints compel the Fed to stop tightening policies. Now, the reaction of the asset prices overnight was the classic US dollar down, yields down, and stocks up scenario. In particular, the move was most pronounced in the drop in US dollar, with the DXY index opening high and closing right at the lows, a drop by almost 1.5%. That move was the biggest intraday drop in DXY over the last few years. Now, the move in US equities was more interesting. While the S&P 500 index was up day on day, it actually pulled back from intraday high and closed near the day's lows. This may reflect the risk that the Fed may over-tighten. Now, remember that a meaningful labor market deterioration is likely to be a prerequisite for policymakers to pivot into cutting interest rates. So therefore, restrictive monetary policy is ultimately a headwind for the economic outlook. So, do not forget about gold. Gold also had a strong move overnight, benefiting from the weakness in US dollar. It had been holding up well just below the 1900 US dollar level, and it is challenging resistance at 1960 at this moment in time. Gold is likely to be a good portfolio diversifier to add to, should the Fed over-tighten and the economy enters a recession. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.